welcome back to my channel. Today's video is all about how to grow a small trading account, specifically how to grow a small trading account from $200 to $20,000. Now, let me start by saying that growing a small account is not always easy. It's certainly not an overnight process because trading and investing takes time. So with that, this will be a multi-part video because I'll provide more details and strategies in future videos. So to start, I want to discuss the importance of selecting the right option contracts. This entails taking into account elements such as the strike price, DTE, implied volatility, and the option Greeks. When you carefully consider these factors, you heighten your ability to grow a small trading account progressively. Now, when discussing option contracts, liquidity is key. You want to make sure you choose contracts with higher open interest and volume so that you can place trades and exit them with minimal slippage. And for those of you who are unaware of what slippage is, it's simply the difference in the expected price of a trade and the actual price at which the trade is executed. So for example, if you place an order to buy a stock at $100, but the market momentum causes the order to get filled at $100.20, the 20 cents difference is known as a slippage. And this isn't uncommon to happen. But again, if you closely consider the factors of contracts with higher open interest and volume, it becomes easier to avoid it. And that's just simply because an option contract on a widely traded stock with high volume is more valuable to trade than one with low volume. And that goes hand in hand with implied volatility. High implied volatility typically raises the cost of premiums, and this is beneficial for growing a small trading account if you expect the high price movements, whereas low implied volatility results in inexpensive premiums, and buying these contracts is usually only advantageous if you anticipate the volatility to increase in the future. Meaning, if you're swing trading and your game plan is to profit off the projected price motion of a stock, assumingly this can play in your favor. Now, in regard to choosing the right contracts to grow a small trading account, it's important to focus on selecting contracts that are in the money because these options have intrinsic value and therefore a higher probability of being profitable. But again, if you're swing trading, you may adopt a completely different strategy for trading in the money, at the money, and out the money. And the DTE plays a role in this as well. Now, one of the factors that is most important when the focus is on how to grow a small trading account is to have a predetermined exit strategy. So setting a trail stop or stop loss is essential in risk management. For me, I'm just speaking from my own personal experience, y'all. A trail stop is more effective for securing profits if a trade goes against me than a stop loss. Reason being is because a trail stop follows the stock directionally. Now, a trail stop still functions the same way a stop loss does, but the difference is that it safeguards your profits from a huge loss if a trade doesn't go in your favor. So for example, if you put in a play for calls and the stock price does rise, a trail stop will follow your profits on the way up. And if the stock falls, the trail stop will not decline. So this allows you to lock in your profits before taking a major L on a trade. And it also works vice versa. If you put in a play for puts, it'll follow the stock price downward and it won't rise above your set dollar value or percentage, which again secures your gains. So I hope that makes sense. And I have a video explaining the specific details between the two, but either way, the main point is to maintain sound risk management because when we talk about the ways on how to grow a small trading account, it's absolutely necessary to retain as much money as possible. Even if the trade goes against you, you still ultimately want to reduce your loss to be as minimal as possible. And that's one of the ways to create the maximum amount of leverage to grow a small trading account. Now, of course, I mentioned the positives, but I also want to mention one of the disadvantages, which is that when a stock or ETF is volatile, a trailing stop may trigger too quickly, which results in an early exit of a trade. The downside to this is that it may not give the stock or ETF a fair chance to recover and correct itself before the position is exited. But from my experience, a trail stop plays into my favor more often than not. So if you've never used a trail stop before, you may want to test it out to see if it works for your trading strategy, and you can paper trade to try it if you don't feel comfortable with using real money to test it out. Okay, so I want to provide an example to illustrate how a trail stop works, just to make things comprehensive. So you can have it set for a percentage-based amount or a fixed amount. With the percentage-based amount, let's say for example you set your trailing stop to 10%, which y'all know I like to keep my risk tolerance at no more than 15% on a trade. So if the share price is $100, the trail stop will be initially set to $90, and if the stock or ETF rises to, let's say, $110, the trail stop price will adjust itself to $99. And this just means you would only run the risk of losing 10% if the stock declines from the new trail stop level. So I hope that makes sense. Now with the fixed amount, it's nearly the same thing. If the share price is $100 and you set a $10 trailing stop, the initial stop price will be set to $90. And if the stock or ETF rises to $110, the trail stop price will adjust itself up to $100. So I'm hoping this example ties everything together to make sense, because it's basically a strategy to secure more of your profits. And that's why I often prefer a trail stop over a standard stop loss. And again, going back to it, if you're trying to grow a small trading account, taking minimal L's is much better than taking larger ones. And in this example, it's not even an L, it's really just breaking even. Now, of course, you'll need to account the Greeks into the scenario to provide full context, but y'all see how this technique is useful. Okay, so the next important factors on how to grow an account involves S&D and S&R, which are supply and demand and support and resistance. This is an essential aspect of technical analysis because when you're seeking to put in a play for calls, your focus is on analyzing demand zones because you're projecting a price increase. And for put options, the focus is on supply zones where the anticipated price may decrease. So to say this simply, you buy calls in demand zones and puts in supply zones. Now with reference to support and resistance, you'll need to evaluate call options near support levels and put options near resistance levels. And this helps to capitalize on price movements to build and grow your small trading account. And if y'all want, I can make a dedicated video about these concepts to help you improve your overall strategies. Alright, so one of the last tips I want to mention is testing out your strategies and tracking your performance. When you're learning how to grow your account and utilizing various strategies, it's important to understand position sizing. You want to begin with smaller positions, and then over time, you can progressively increase the size of your trades. Meaning, once you get more comfortable and confident with your trading, your position sizing can get larger, hence how you grow your trading account. So for instance, if you start with a $500 position and the play goes in your favor multiple times, you then may want to scale up to $1,000 while still maintaining your risk tolerance. So this goes back to how you can gradually grow $200 to $20,000 over time, because that $1,000 position size will grow as well. And that highlights one of the complexities of trading, especially with the goal to grow a small trading account. Along with that, it's also necessary to track your performance. You should have a record of your P&L to analyze the outcomes and your trading rationale. So you may often want to review your trades and break down your strategies, the ones that worked and the ones that didn't. And this requires a certain level of intentionality. Not only that, it's really going above and beyond just hopping into a trade and exiting without any means of evaluation and reflection. Now, some traders trade the same setups over and over again, and they're able to be successful because they've tested their strategies and tracked their performance. And there's absolutely nothing wrong with playing the same setups. As a matter of fact, it's more advantageous to do so when the focus is on how to grow when trading. So all in all, practice and patience will go a long way. It's really just a matter of strategically planning the methods in which you can grow a small trading account in ways that best serve your trading style. And another really good recommendation that goes with this to elevate your trading success is to frequently backtest your trades before you go all in. And backtesting is the process of evaluating a trading strategy by using it with historical data to determine performance. So this allows traders to assess the viability and the effectiveness of a strategy before applying it in real life trading. It's like a simulation for past trades. And backtesting helps identify potential strengths and weaknesses as well, so that's good to know. And it also helps you to optimize any strategy, and you can build confidence because of the ability to deliver positive results. And it's worth noting that backtesting isn't just for beginners, even pros use it to stay sharp. So just make sure as you grow, you fully invest in the process and you'll see your outcomes improve. And with that, that'll pretty much do it for this video. If you found this information to be helpful, feel free to leave a comment down below. As always, I thank you so much for watching, and I'll see you in my next one.